Hey, Courtney Smith here. A fascinating study here on the institutional investor site where they wrap up a study that was just done that compares which is better for a stock price, stock buybacks or dividends. And what they did was they studied just the most recent 3 years, so it's not exactly the longest study that you can imagine, and so we have to think that maybe it's not super valid, but it did come up with some interesting results. And here's what it is right here. Companies that did buybacks and nothing else during the 3 years generated an average unweighted total return of minus 10.5%. Now remember, of course, this included 2008. So that's what companies that did buybacks and nothing else, that's what they came up with. Now that compares with a minus 12.7% for companies that only issued dividends. Now, the interesting thing to me was that those that paid dividends and did a stock buyback did the worst. They lost 21.3%. Now, the ones that were the most important category, though, was that companies that did high-frequency buybacks performed by far the best. Their total returns fell just 4.4%. So that's a much better performance than any of the other categories. But best performance was those that did high-frequency buybacks. That was the best. And then those that did buybacks and nothing else did the second best. Companies that issued dividends were third. And if they did stock and dividends, that was the worst of all. So I think it's pretty strong evidence that stock buybacks are better than dividends. But I think that there's something that's even more important here. This talks about what did the stock do. But also remember that dividends, dividends are counted in here. In this minus 12.7% for dividends, they're counting in the dividends that were received. But dividends, generally speaking, are taxable. It's possible if they're in a retirement plan that they're not taxable, but dividends otherwise are taxable when the stockholder receives them. But stock buybacks are not. They are tax deferred until you sell the stock. So stock buybacks are still better for the investor than dividends in most cases. Now this factor, the stock buybacks being more bullish than dividends, is a continuing supporting element in the technique that I've developed called Pit Bulls of the Dow. And Pit Bulls of the Dow is an adaptation of Michael O'Shaughnessy's Dogs of the Dow, which is based on an old concept called fallen angels that dates back probably 100 years in the stock market. But nonetheless, whenever you see a company doing stock buybacks, that's a bullish feature and you should pay closer attention.